So I'll just jump right in.
Cool.
So last time that we
Yeah.
talked, last time we held this call, the market was in the process of breaking down, and not just like trading down a little bit. It was breaking through some really clear support levels and in a really bearish spot. And we, in our portfolio, we were bearing up, as they say in the fund management world. We were putting on our bearish
Yeah.
positions and ready to profit from this fall in the market. And then a funny thing happened after the S&P 500 sliced through its 200-day moving average, indicating the textbook breakdown. The sell off just reversed course very abruptly, and part of it was because Jerome Powell during the Fed conference he held interest rates steady and he adopted a much more dovish tone. So that gave investors a reason to be a little bit more a little bit more confident. Then we had some inflation readings that came in a little bit better than expected. So people thought, oh, good, inflation is maybe under control or a little closer to being under control. So maybe the Fed won't have to raise rates as much and we won't have to kill the economy. And then we had the job market or the job report last week that was a relatively weak report, which this is one of those times where bad news equals good news for investors because investors are saying, well, if the job market is becoming a little bit weaker, then the Fed may not have to tighten. We may not have to kill the economy. We may be able to be a little bit more dovish. And so stocks traded sharply higher. This has been one of the most abrupt and brutal in a certain way rebounds in the market that we've seen. Just because it changed, it completely changed the narrative from we're selling off and this is a really bearish position to all of a sudden investors had this fear of missing out and this kind of frantic buying that drove the market higher. Now, we'll have to say, I don't trust this rally. I want to go on record saying that. Um,
Okay.
it's happening for all the wrong reasons. So stocks are trading higher right now because of FOMO, fear of missing out. Investors, they don't really have a good reason to buy. They just have less of a reason to sell. Uh, it's not like we're seeing tremendous strength in the economy. It's not like we're seeing tremendous growth in earnings or future earnings expectation. We're just saying, well, interest rates aren't going to keep going up, so buy stocks. That's not really a good reason to make long-term investment. A weaker economy is not a good thing long-term for stocks. And then earnings season. We're right in the middle of earnings season. We're probably about two-thirds of the way through all the big names reporting. And earnings are coming in okay, literally just meh, okay. We're not seeing strong earnings. And really, the guidance that we're getting from many key executives is weaker. So as they look forward into the fourth quarter and they look into next year, they're saying, you know, we did okay this past quarter, but we're not sure what's going to happen going forward. And so those are not the things that you would really expect to see if we're at the beginning of a really good bull market run. This is more of a um, just a reflex bull market than something that I feel like we can have a lot of confidence in. One of the biggest and most important things that I learned. Go ahead, Chris.
I, I just want to jump in. Steve had a pretty good question based on kind of what you're talking about. What about just normal seasonality? How does that play into this?
Yes.
Like,
Yeah, absolutely. And there is some seasonality. This is typically a strong season for stocks. November, December tend to be stronger times. Just about 70% of the time, 70 to 75% of the time, over the last 100 years, we've had gains in November and December. So there is definitely some seasonality that helps to boost that. But at the same time, when we look at the fundamentals and the economics and broad economy, there's less reason to be very confident
yeah,
in this move. One of the things that I learned at the hedge fund and kind of had drilled into my head during several different key bearish periods in the market is that the biggest stock market rallies typically come within the context of an overall bear market or of an overall uh, bearish period. And that's because investors get fearful that they're going to miss out. And also because investor sentiment becomes so negative and a lot of people set up short positions. And then when markets start to rally, they have to cover those short positions. And that helps to reinforce this short-term rebound and drive the market higher. And then once that buying is exhausted, then we can roll over. Now, I was talking to Greg Gunther yesterday, and he said his crystal ball's in the shop, and ours may be shattered.
Yeah.
Nobody has a
Uh-huh.
crystal ball.
Man.
You can't just say, all right, this is what's going to happen in the market tomorrow and really know for certain. But you can look at the clues of what has happened in history, what is going on fundamentally, what's going on in the economy, how are companies earning money, what are they projecting in the future, and those are great clues to help you understand which way the direction of the market is going to be and how you need to set up your investments. So another phrase from the hedge fund days, I was taught to respect the price action, but not defer to it. So we've got stocks moving higher right now. We have to respect the fact that stocks are moving higher, but it doesn't mean that we need to defer to it, that we need to buy stocks that are vulnerable, that are risky, that could trade lower and wind up putting ourselves in a vulnerable position where then again, once the stock market trades back down, we could be left holding the bag. So we want to respect the price action, and that's why we actually covered some of our bearish positions that were moving against us. Last week or earlier this week, we covered Amazon. We closed out our bearish Amazon position, and we closed out our bearish Spotify position today because they're not moving in the direction that we want to. So that's respecting the price action. But we're not deferring to it. We're still looking very carefully at the weak fundamentals, the macro risks. And in this case, in this instance right now, I prefer to use this recent rebound that we've got in the market to set up new bearish plays on very weak stocks that have only slightly moved higher as the market has kind of surged higher over the last week or so. So there's a concept of relative strength, and relative strength just says, how strong is my stock compared to the strength of the overall market? So if the overall market moves up by 10% and my stock moves up 5%, we would say that I have poor relative strength. If the overall market moves up 10% and my stock moves up 20%, you would say that stock has strong relative strength, or it has more relative strength. And so in this case, there are many stocks that have sold off, that have broken through key support levels, that are in bearish overall trends. And this stock market rally has allowed them to bounce a little bit, but not nearly as much as the rest of the market. JB Hunt is a perfect example of that. And we'll get to that here in
Yeah.
a second when we look at our individual positions. But now is a great time to be watching for those stocks that have broken down, that are extremely weak, that are having just a slight rebound compared to the market's overall rebound, and to set up bearish positions on those plays. If you're comfortable buying put contracts, I love that idea. If you're not comfortable buying put contracts, you could short the stock, but that involves a little bit more risk because you don't know how high a stock could go. But I think this is a perfect time to isolate some of those weaker stocks and to be able to set up bearish positions based on this most recent market rally, that gives you a better entry point for those plays.